Good afternoon, everyone, and welcome to Unlock the Stock. We're pleased to welcome Bell Equipment Black onto the platform. This Unlock the Stock platform is specifically designed for retail investors to gain access to corporate management and to get to know the companies just a little bit better. Ashley Bell, the CEO, and Karen van Hart, the CFO, will take you through a presentation shortly. As you also know by now, Unlock the Stock is not possible without our technology partners, Lumi Global. Visit their website at lumiglobal.com if you want to learn more about their various online AGM and investor presentation solutions. Our host today, as usual, will be the Finance Ghost and Mark Tobin of Coffee Microcaps, and they will be facilitating the Q&A session at the end of Ashley's presentation. But before we get into that, there are just a few housekeeping rules. Ashley and Karen will take you through a presentation, which will be followed by a Q&A. Please note that you can post your questions in the Q&A box at the bottom of your screen. The event is being recorded and will be available on the Unlock the Stock YouTube channel, probably around Monday. You will see an email address when we get to the Q&A section, and if you'd like to be added to Bell's contact database, please take note of that address and send us an email. Ashley, I think that's it in terms of the intro. We are happy for you to share your presentation with us and take us through it.
Thanks very much, Vanessa. Thank you for the opportunity to present on Bell Equipment, and in particular our 2023 year. I'm going to run you through a operational update, and then I've got Karen van Hart here who will then touch on some of the financial aspects, and we'll close out with a view ahead for the business, and then take some time to answer any questions that you might have. So maybe just to start out, just an overview of our current business structure. Essentially, we've currently got two major business streams, and that's the global OEM business as well as a dealership business stream. And the OEM business stream is essentially the core function of that business is to design and build products, both agricultural and mining and construction products, which it then sells to dealerships out there, and then we support, as the OEM, we support those dealerships to support those machines in the field. In the dealership business stream that we've got, we sell those products, we procure those products, the products from OEMs, and then sell those products onto end users and support those end users in the aftermarket. And at Bell, we own our own dealership networks in around South Africa, Zimbabwe, Zambia, and then in the UK specifically. There's a third more defined stream that's coming online now, which is the Bell Heavy Industry stream, which we've touched on in a number of media releases and through our last investor presentations. And this is a specialized contract manufacturing stream, which will be located at our Richards Bay factory. And it will carry out manufacturing services for our OEM business, as well as potentially other OEMs and third parties in related industries to ours. Just on to our global reach, we've managed to position ourselves as a global OEM from the southern tip of Africa, which has been no small feat. And we now have a reach of 112 independent dealers globally. And this is in addition to our 4 dealership businesses that I mentioned in the previous slide, of which in South Africa we have 22 of our own Bell-owned branches, outlets, and we have the most comprehensive network of outlets in our industry, certainly in South Africa. We have machines operating in over 80 countries around the world, and we produce our products out of our 2 factories, one in Richards Bay and the other in Eisenach, Germany. So on to a summary for the year, and I'm not going to go through it point for point, but essentially, the year, to sum up the year, we had very strong global demand for our products, and this was on the back of the commodity cycle, as well as a number of large infrastructure projects in certain parts of the world. That resulted in a very healthy order book. Obviously in South Africa, through our dealership business, our third-party product lines also continued a very positive trajectory. Some of the challenges that we experienced through the year, in particular, supply chain challenges and constraints with certain of our suppliers, as well as logistics challenges with South African port congestion, which caused various delays through the year, and resulted in us having to put in significant inventory buffers to deal with these delays. I've just got a couple of slides which show some images now of our different operations. This is an aerial view of our Richards Bay manufacturing facility, and you can see there that we've put in quite an extensive solar power installation, which is to supplement our generators that we use as backup to load shedding. This facility is still our primary manufacturing facility at this stage, and it produces a kit which we supply to Germany, to our factory in Germany for assembly. This is the German assembly facility, and this is where we are looking to enhance our manufacturing capabilities to reduce our reliance on our South African factory, and to minimize the round tripping of components and materials that we're currently having to ship to the southern tip of Africa and back to the northern hemisphere again. This is our Elsfeld logistics center in Germany, and this is basically to support the demand for parts in the aftermarket to our European dealer and customer base. On to just a summary on the OEM business that I touched on earlier. The external dealer sales from our OEM in South Africa, or the OEM business in South Africa, accounted for around just short of 20% of our total group sales, and our sales out of our European OEM business, out of the European factory, accounted for around 41% of, or just shy of 42% of group sales. So we have seen a relative growth in our northern hemisphere markets, and this shift, which has exacerbated the downside to round tripping materials all around the world. Production rates at both factories increased as a result of the increased demand for our products, and volume is critical to our business, so we were pleased with that. On the parts logistics side of things, or customer support side, we had further optimization of our parts logistics hubs, and we've got 3 hubs, one located in Johannesburg, South Africa. The other is at Elsfeld in Germany, which is the last image that I showed you, and we made a significant investment in 2023 in our American logistics center as well, which is in Charleston, South Carolina. During the second half of the 2023 year, supply chain challenges did ease slightly, and so we were able to catch up on planned production, but we did have some significant challenges towards the end of last year with South African port congestion issues, as well as some labor shortage issues in Europe. In terms of our outlook and expectations, our key markets out there are without a doubt showing signs of normalizing and cooling off, and our focus going forward now is going to be to grow our market share in these key markets. We continue to invest a significant amount of money in new IP development, both in enhancement to our existing products as well as new products that we've got coming online. And we've got a separate slide on that coming up. We want to, our biggest strategic imperative is to enhance our ADT manufacturing capabilities in Europe, and to position those manufacturing activities closer to our suppliers and growth markets. Together with that initiative, we need to bring some of these other new products that we've had in development online through production in Richards Bay to take up the capacity in the Richards Bay factory, as well as to try and dovetail our BHI contract manufacturing services to third parties as well to take up some of that capacity. Going forward, South African port challenges are expected to continue. As far as we can see, we have not experienced any significant improvement in the situation, but nor has it got any worse. So we're still managing about a 3-week delay in handling goods through the South African ports. Onto our direct sales operations. This aerial view here is just our Johannesburg operation, which is the head office for our South African sales or South African dealership business. And the big warehouse in the foreground that you can see there is our global logistics center as well, which is to support the aftermarket business. Onto direct sales for our South Africa, Zambia, and Zimbabwe operations. We had, as with all markets, significant improvement in our sales from our dealership business, and in total, our South African dealership made up 32.5% of our group sales. In Zambia and Zimbabwe, dealership sales improved largely on the back of the performance of our Zambian operation, where Zimbabwe remained a really challenging operating environment for us. The demand for ADTs in both South Africa and Zambia was very strong, and this was on the back of the commodity cycle. And in South Africa, we see that the construction sector remained still very volatile. Lead time challenges across all OEMs, including not only belt production, but we saw it with the other OEM partner products that we distribute through our South African dealership business, being Kobelco, JCB, and Finlay. There's definitely was a lot of pressure from a supply chain perspective on the industry. In order to cater for the increased demand, we increased our inventory quite significantly across the business. In terms of our outlook and expectations, we are cautiously optimistic that momentum from certain mining sectors will be maintained. Export coal sector for us out of South Africa is a concern. Has slowed down significantly. But for instance, in Zambia, the copper industry is looking really promising. And our focus through 2024 is to regain some market share that we lost as a result of supply constraints through 2023. And we have an ongoing focus on our lifetime revenue stream, which is essentially the aftermarket business and supporting our customers in the field. As one of our founding values in Bell is that if our customers succeed, then so will we. South African national elections this year is a concern for us. There's a little bit of uncertainty as to what to expect in terms of the impact on our operations in South Africa. The political challenges in Zimbabwe we don't expect to be ending anytime soon. Onto sustainability and our strategic positioning. So we continue to invest in ongoing new product developments, and as well as enhancements to our existing build products. We are focused on increasing our market share in key markets that we operate in globally. And we are also focused on developing the Bell Heavy Industries division, particularly in terms of offering services to third parties as opposed to strictly only the Bell OEM. And then onto our ADT manufacturing in the Northern Hemisphere. This, as I pointed out, is our biggest strategic imperative at this stage. We have to produce these products closer to our markets and our component suppliers. We've seen a relatively larger growth in our Northern Hemisphere markets, where now approximately 2/3 of the product or ADT product that we produce is sold into the Northern Hemisphere, and approximately 2/3 of our suppliers now come from the Northern Hemisphere. So we have to minimize the round tripping of materials and components to the southern tip of Africa. Not only will this have make some improvements on the returns that we're able to deliver, but it will also improve our flexibility and responsiveness to changes in markets, as we'll be shortening our pipeline of incoming materials and components and our flexibility to respond. At the moment, we are having to deal with around a 6 to 7 month pipeline of incoming materials and components. So when things change in the market, we're not able to respond as quickly as we would like. And then, lastly, well, not lastly, I've got a couple more slides, but to align the repositioning of our ADT manufacturing in the Northern Hemisphere as closely as possible with the new products that we're bringing online in Richards Bay, as well as the contract manufacturing for third parties that I've pointed out already. We are well positioned in South Africa from a BEE perspective with our South African manufacturing business, a level 3 contributor, as well as our South African sales company, a level 1 contributor. On to our growth and investment strategy, and this is focusing on our new product developments that we've had on the go. The Bell Motor Grader is a product that the market has heard a lot about over the last couple of years. We've had some prototype units running for probably the last 2 years. The development that we've had on the go for approximately 4 years. The prototype units have performed exceptionally well, and our focus now is to start preparing to bring this product online in terms of production from the start of 2025. We truly believe that we have developed a winning product in this grader, a world-class product in terms of innovation, performance, and reliability, that it should take its place quite comfortably alongside our ADT in the global markets. On to ADT innovation. One of our most exciting projects that we've been working on in terms of enhancements to our ADT product has been in the autonomous driverless ADT space. And without a doubt, Bell is at the forefront of this race in the market to deliver a machine to operations where an operator is not required in the cab of the machine. All of our ADTs that are delivered today are delivered autonomous ready. So they are plug and play in terms of a autonomous control system to be integrated to the truck. And we recently participated in the launch of the UK's first commercial autonomous ADT operation, or should I say above surface ADT autonomous operation, which went off very well, and we see a lot of opportunity in the space, particularly in the Northern Hemisphere. We continue to invest R&D into sustainable fuel and propulsion solutions to support a zero carbon future. On the underground mining space, we have for the last number of years, we've produced a form of underground articulated dump truck, which is a lower profile machine. But we've never really put a specific or had any specific focus on this area of the business. And we do see this as an opportunity for us to participate in the underground mining space. And our underground mining truck has undergone a significant upgrade or design upgrade in the last 3 years. And that product is now ready, and we are already starting to make some deliveries to market on that underground truck, although very small volumes in comparison to the above surface ADT. To complement underground ADT, we've been developing a 6-ton load haul dumper, which is commonly referred to as an LHD. And we have 2 prototypes in build currently, which we should be commissioning during the second quarter of 2024 for testing. And then on the forestry and agriculture sector of the business, we have an exciting new product in the form of a timber processing head, which would typically be attached to an excavator or a purpose-built forestry carrier machine. And this is used for mechanized harvesting of trees, and that head is used to debark and debranch trees that have been felled, as well as cut those trees into the required lengths by the mill. We have had some really positive results from the testing of this product, and we are planning to go into production during the first half of 2025. I'm now going to hand over to Karen to take you through some of the financial results of the business for the 2023 year before we look at the what we have ahead of us.
Thank you, Ashley, and good afternoon, everybody. Revenue for the group for the year to December 2023 increased by a healthy 32% to 13.5 billion rand from 10.3 billion rand in 2022. And this resulted in a 69% increase in operating profit to 1.2 billion rand from 705 million rand in 2022. On to key aspects regarding the inventory holding of the group. In order to achieve the sales growth, the group had to invest more into inventory, which increased by 21% to 5.7 billion rand in 2023. What we do at Bell is we measure inventory days, and we ended the 2023 year at 193 inventory days, which, considering the port issues and other supply chain challenges experienced, we were reasonably comfortable with, especially considering that the 193 days was the lowest level that we've achieved as a group for a number of years. If you look at the breakdown of the inventory, the highest percentage change was in the area of finished manufacturing, and that related to port delays, and specifically vessel sailing delays out of the South African ports. And those machines were shipped to customers early in 2024, specifically in customers in the North American and Australasian markets. The increase in spares and in work in progress on the schedule reflects the high production volumes going into 2024, and also the buffers that we have in place in order to try and mitigate the port delays and the other supply chain challenges that we're dealing with. On to debt and finance costs. As a result of funding higher levels of inventory, the average debt levels for the group were higher in 2023 than in 2022, and the interest costs for the year were also at a higher level than in the prior year. However, the interest cover and the net debt to EBITDA ratios had improved in 2023 as a result of the improvement in operating profit. We target a gearing level of around 30% and not higher than 40%. And having ended the year at 29% last year, we were quite satisfied with that outcome. Onto the segmental revenue. All segments increased revenue for 2023, with the greatest increase being evident in the European segment, or the European manufacturing segment. And the reason for that was an increased level of sales to the North American market, which are reflected in the Europe segment. The North American market is the largest ADT market in the world, and we were satisfied and quite happy with the increase in sales volumes to that market in 2023. Onto the operating profit per segment. Again, all segments reflected an increase in operating profit for the year. The highest increase is evident in the South African manufacturing segment, and the reason for that is higher throughput. Ashley mentioned the importance of volume, and that is the reason in the South African manufacturing operation, because we had a higher level of finished goods and also kits for the European facility completed through the Richards Bay facility in 2023.
Looking ahead, maybe just to point out, this image is of our underground mining truck, which I mentioned we have started making some deliveries. Looking ahead, we are monitoring global markets very closely, as we are seeing signs of demand normalizing. And we have a strategic focus on the USA, which is the world's largest ADT market, and it's a market where we have our largest growth potential. We will continue to vigorously pursue growth opportunities in existing markets, and particularly markets where which are large ADT markets where Bell has a relatively low market share, which is the case in the USA, for instance. We continue to drive technology innovation, such as the autonomous truck that I pointed out a little earlier. And we have a planned launch of our complementary global products, both in mining and construction, as well as forestry and agriculture segments. We have a continued focus, and this is a major focus within the business at the moment, on expanding our ADT manufacturing capabilities and capacity in the Northern Hemisphere. We have to position this activity closer to our suppliers and markets. And that's all from us in terms of the presentation. So we can take some questions, and between Karen and I will be able to answer.
Great. Thank you very much, Ashley. I'm going to hand everyone over to Mark and the finance ghost, and they will just chat you through the questions that they've received.
Thanks, Vanessa. Thanks, Ashley and Karen, for the presentation. I just want to start off kind of just where you just finished, Ashley, if I may, on the new products that are going to be, coming on stream, let's say, over the next 18 to 24 months. Have you already secured pre-orders with some existing customers for these, or is it you're just refining the last of the manufacturing and then it's going to be into the whole hamster wheel of business development, trade shows, all of that kind of thing? Maybe just in terms of where the commercial piece on these new products is, maybe if you could go a little bit deeper on that, that'd be great.
Yeah, so at this stage, we're not in a position to secure orders, but it would be likely that we would start to secure orders from the fourth quarter of 2024 for 2025 production. And I'm talking specifically about the grader, which has been our most significant R&D investment over the last 4 years. So at this stage, we have a batch of what we would refer to as pre-production units in build. So this would be, as you can appreciate, I'm sure the prototype machine is there to test and to try new things and to test components and that sort of thing, and is not quite as refined as what you would expect the final product to be, or what our customers would expect the final product to be. So that's what we That's what we produce in terms of these pre-production machines, which are in build as we speak, and with production for sale coming online from the start of 2025, we would expect to start taking orders from Q4 2024.
Yeah, perfect. Thank you.
Hi, everyone, and please do send through those questions. Thank you for those received already. And Ashley, Karen, thank you for your time today. So Ashley, I think the first question I've received is for you, which is really around understanding Bell's competitive advantages versus other similar companies. So I always enjoy the quite high-level strategic questions because it does help with understanding how the business actually works. So is it selling points or selling prices rather? Is it other stuff? What is really helping you win against competitors? And then who are those competitors? I've received that question a couple of times already, not just in South Africa, but internationally. So I think just some commentary around that would be great.
Yeah, so I think internationally, our biggest competitors are essentially Volvo, Caterpillar, there's Komatsu, John Deere, particularly in the US. We do produce the most technologically advanced ADT, and we have a very strong. We are the ADT specialists out there in the market, and we have a very talented and experienced team of engineers, particularly around ADTs, and we pride ourselves in delivering or producing the most efficient package in terms of from a product performance and productivity perspective. One of the, and I suppose one could view it as a disadvantage but we take it as an advantage. But, one of the advantages that we have got is that we are not bound to using proprietary components in our products. So we can go out and we can pick the best of what the world can offer in terms of engines, transmissions, and other components that go into an ADT to really put together the best performing and most efficient package in terms of a driveline, for the product. And I think to a great extent that is an advantage that we have in the market, as well as a lot of the technological innovations that we incorporate into our design.
Maybe if I follow up on that would be those technological advantages. I mean, to what extent are those either patent protected or, what is the moat there on these ADTs in particular versus some of your competitors?
Yeah, so we don't patent protect any of those advantages. Typically in the history of the company, we haven't really been too strong on patents, and I think you have to really have something that's very novel to warrant going to that extent in terms of putting a patent in place.
And Ashley, I think this one may be more for Karen than for yourself, but if you want to take it, feel free to do so. I'm just trying to get an understanding of, you're talking about expanding the manufacturing capability in the Northern Hemisphere so that you're kind of closer to where those customers are based. But in terms of how that impacts group margins, because, I think of it on one side, you're going to have lower logistics costs and, more of a natural hedge from an FX point of view. But then on the flip side, the employee costs and that are more expensive on the other side. So maybe just talk about, is it going to have any kind of impact on margins at a group level, or does it all kind of net out in the wash and, your kind of margins are going to kind of stay broadly similar even after this kind of process has been completed?
Yeah, so I can answer that, and Karen can chip in if she needs to. But essentially, we primarily focus on ROIC. So there are higher operating costs, and yes, there will be significant savings in terms of logistics costs and freight, etc., on the round tripping of components. But there will be a significant reduction in working capital as well. And coupled with that, a reduction in debt and therefore lower interest costs as well. And all of this, should have a positive impact on the ROIC. But aside from the financial aspect, I think our ability to respond to changes in the market is actually a more significant advantage for us. At the moment, as I pointed out in the presentation, we're managing quite a significant pipeline of incoming components, and so when we see markets sort of slowing down to some extent that we see currently, we've still got materials and components incoming, and we need to pay for them. So having that flexibility, shortening that working capital cycle, and giving us that ability to respond a lot quicker to both the turns up and down in the market will bring resilience to the business as well.
Okay, perfect.
I've received a question on the working capital points. Obviously, I haven't had time to actually check if this point is right, but I suppose it probably is, which is to say that Bell's got higher inventory days and lower inventory turnover than some of your global comps. So Komatsu, Volvo, Caterpillar. Assuming that is correct, and obviously I haven't been able to check that in the last 30 seconds. Do you comp yourself against those players? Can you get to their levels? I mean, obviously you guys are doing a lot of work around where you are manufacturing and why. There's a lot happening at Bell, but maybe just some more commentary around, how efficient can you get, and do you comp yourselves against those sort of players?
Yeah, so I think, for us, it's essentially balancing. If I'm understanding the question correctly, it's balancing our investment in inventory with the margins that we earn. So at the moment we do have a significant investment in working capital and in inventory, because we are, for us to scale up to meet the global demand out there, given the length of our working capital cycle, it's a significant investment in the round tripping of materials.
We also structured very differently to our competition, in that Bell, in some instances, owns its distribution operations, whereas if you look at the competition, they have a different structure where they sell to independent dealers when the product leaves the gate. So their working capital cycle is a lot shorter than the Bell scenario. Yeah. So I would add that to the discussion that we've had around the strategic objective to locate most of the manufacturing closer to suppliers and closer to customers in the Northern Hemisphere. The second aspect is the own distribution operations.
Yeah.
Can I just would quickly switch tack a little bit here, and we'll go to the dealer model and the transition that's been happening there and the expansion of sites, Ashley. I mean, how many more sites do you think you can expand to, if we just take the Southern Africa business or the Africa business more broadly in general, or is that kind of transition and adjusting of the model kind of complete now? Maybe just give us a bit more color on that one.
So right now in South Africa, the expansion of our independent dealer network in South Africa has been very much centered around the forestry and agriculture machines. So a lot of our, although some of our outlets through our own dealership network in South Africa are focused on forestry and agriculture, many of them are focused on mining and construction. So the intention with expanding to an independent network was really to have a sort of a greater reach into the forestry and agriculture space in South Africa. So in terms of that process, I mean, we've appointed an extensive number of dealers over the last 18 months, and I think we're up to about 24 dealers with a total of 49 outlets. And some of those include our, certain of our own dealership outlets as well. We won't be expanding significantly more than that in South Africa. I think that we've reached a point where we're pretty well covered, and now it's going to be to develop those dealers and to have them grow, their sales of our products, work with them to grow their sales of our products.
Yeah. And then just a question then on the grader, if we go back to that product, in terms of key markets where that's going to be launched, is it get ahead well entrenched in the South Africa market, with the guys who supply contracts to Sanrail, or are you thinking, no, it's more of an international product, and that's going to be the push from day one, is to really get this product out into the international markets? And yes, we can focus on South Africa, but I'm just trying to think of where the main push on that grader is going to be through 2025.
Yeah, so the grader, one of the advantages for us in terms of developing a grader is that there is a fairly substantial market in Southern Africa, but the Southern Hemisphere. But that said, there's significant potential for the products in the Northern Hemisphere as well. But we will be starting with Southern Hemisphere, and in particular Southern Africa. So we will focus on our markets closest to home to get the product, to establish the product in the market, and to grow the numbers locally, and in time we will look to penetrate other markets, particularly the Northern Hemisphere.
My next question's around just gross margin and directionally, what some of the drivers are of that thing, because that's obviously a big focus, I think, for anyone investing in the business. And there are a lot of moving parts here. So you've got how the manufacturing is moving around. You've got dealer sales versus more sort of direct sales. You've got sales of parts potentially versus sales of different machinery across different segments. I think just a broad question, because obviously, you can't really give absolute specifics on this, and anything is going to be a forecast, but directionally, what is your outlook for gross margin in terms of strategically how your business is doing? So taking the macroeconomic stuff out of it, just overall how you're getting to market, where you're moving your manufacturing and everything else. Directionally, what do you think gross margin might do? Up, down, sideways? I think that'll help people maybe model out how they think about Bell.
Yeah, so I think, as you pointed out, there are a significant number of factors that play into it, and we've got such a mix of distribution models. As you pointed out, from our own distribution to dealers, to independent dealers, as well as distributors that sit in between ourselves and as an OEM and independent dealers. And it also, very much depends on the mix of products that we sell too, whether it's third-party products or our own OEM products, and even within our own OEM products, the mix once again between some of our products we have higher margin than others. But I would say that the gross margin that has been fairly consistent over the years, and I would expect that it should continue we should maintain it at the levels that we have seen over the last couple of years going forward.
Ashley, I know you touched on the issues at Transnet, and it's a bit disappointing to hear nothing has kind of improved from there, because we had Aprimat on a couple of weeks ago, and Andreas van Heerden, the CEO, was saying they had good engagements with Michel Fillion, the new CEO, and he was kind of starting to see green shoots, but now he's dealing out of Saldanha mainly, and it's iron ore versus what you guys are trying to do there in Richards Bay. But maybe just touch on, have you had any engagements with the the new team there, and you know, is there even any sort of I'd say maybe is it that things are not getting any worse? Is that even a green shoot that we can cling on to here?
Yeah, so yes, we have. I mean, as soon as I was as recent as yesterday, we had one of our executives at the port in Durban, and yeah, the feedback is that the situation, as I pointed out, it has not deteriorated, but it does seem to be quite chaotic still, and it hasn't improved significantly. And you know, I think the impact is really where we're seeing the impact is really on the container handling side of things, on incoming components. So we're having to have suppliers ship approximately 3 weeks sooner than we would have ordinarily had them ship, just to try and factor in that delay. And that obviously means a higher level of working capital employed. And yeah, but we really do hope that you know, we see some improvement in the situation in the short term.
You know, hopefully, what Andrew's just seen starts to carry over into the side of Transnet that you deal with on a more regular basis. If I can jump in with another one, just because it's also a big issue for everybody. Load shedding, while it has been better of late, just in terms of the financial impact of, you know, extra diesel costs and like running generators for you guys, and you know, where the backup supplies in terms of solar investment, you know, what are, you know, the costs coming along for Bell in the next 12 or 18 months, you know, because you can't assume that what's happened in the last month or so, even though it's been much improved, is kind of sustainable.
Yeah, so we have, I mean, it is, I don't know if anyone truly understands the real cost of it, but you know, I think the real costs are a lot more than what we think. But yeah, we do have big diesel generators that we run when, you know, when load shedding is in effect. And as I pointed out in those images there, we've also made a significant investment now in 2023 in a 1 megawatt solar installation to supplement the power supply here at Richards Bay. And we've also agreed with our landlords at our Jet Park facility in Johannesburg to put in a solar installation there as well, which obviously comes at a cost. In terms of our suppliers as well, you know, generally our suppliers have all got some sort of you know, measures or mitigating measures in place to deal with it, you know, alternative sources of power to deal with load shedding. Otherwise, you know, the alternative is, in terms of what some of our suppliers are doing, is that they're working, you know, additional shifts, or, you know, working outside of the sort of load shedding times. But you know, all of this adds cost somewhere that someone's paying for along the line. So, you know, hence me, you know, the fact that I pointed out that I don't know that we truly tally up the real costs of it. But yeah, it's at this stage we don't see it as a massive risk to us, and we have got mitigating measures in place, but it all does come at a cost.
I've got a question that I'd definitely like to get to before we run out of time. So, I mean, obviously the dividend has been a huge focus, right? So obviously the lack thereof to fund the balance sheet. I mean, the market, the share price, we all saw what happened on the day because the market was expecting a divvy, and markets don't love surprises. And I think a lot of the focus now will be on the sort of return on invested capital, because you're adding on to more capital, and that means shareholders will want a return from it. So the question I got is basically to say there's a very positive picture of growth for Bell, and particularly in the Northern Hemisphere. But the question is around funding the investment required. I mean, we've basically already seen the dividend go in terms of, inventory and those sort of concerns. But maybe just higher level than that, how do you see this playing out in terms of dividend policy next couple of years? Are you going to potentially get more aggressive on debt? I won't use that swear word rights offer. I'm sure we're nowhere near there. So it's really asking, how are you planning to fund this thing?
So in terms of the investment that we need to make for this Northern Hemisphere move, we are not planning to replicate what we've got in South Africa. So in South Africa, we have a legacy factory. We have extensive capabilities from a manufacturing perspective. But in the Northern Hemisphere, we have a number of options in terms of being able to outsource a number of manufacturing processes. So we already have we have already made a significant investment in our European factory. Now it's about going out and finding new potential suppliers to source manufactured components from, and ensure that those components are manufactured to our engineering and quality standards. So it's a little bit of a shift in thinking for us. So there's not a significant investment required from our side to make this happen.
Ashley, I'm just checking here quickly now. I don't have any more questions.
I've got one more, Mark.
Okay, you can
but I would like
to.
I'd like to sneak it in if we can. So, on a group like this, you basically get a situation where obviously in an investment cycle among your customers, you're getting way more machines out the door, and then this is a cyclical industry, and that will slow down. And you've talked to some of the cooling off. To what extent in Bell's business model do you have this kind of annuitized revenue piece? So that would be stuff like component sales, parts, service, all of that. I mean, I follow a business like Deere & Co, and they're talking about connected devices and what that could mean for their annuity revenue base over the next kind of 6 years, which is quite interesting. I'm not sure what connectivity looks like underground in a mine. I'm guessing not amazing. I've never been down one myself. So I don't know if connected devices are much of an opportunity for you. It would be interesting to understand that. But just the annuity underpin to your business, or is it this very cyclical, big machines go out the door and that's how we make money?
No, so lifetime revenue stream is a major focal point for us. When we sell a machine to a customer, we essentially we enter into a contract, which probably I'm speaking hypothetically. We enter into a contract which is probably 15-20 years, where he's going to need parts for that machine from us, and parts and support. And we've got, in terms of technology and how technology plays into that, for many years we've had a satellite tracking system that we sell with our products, which we call Fleetmatic, and we're able to track average machine hours out there to better understand service and support requirements, and to sort of preempt services for customers, to ensure that we have the right parts in place to be able to support those customers' machines depending on the hours that the machines are doing. So we are very focused on supporting our customers and ensuring their success, and ensuring that we have the right parts available to maximize their uptime on the machines. And that is, the aftermarket business is really the annuity income that we get from the placement of the machine in the market. Just in terms of your technology question, it's quite interesting, because with that Fleetmatic satellite tracking system, we're also able to track average machine hours out there in the market, in particular markets, to understand what those markets are doing. So I mean, typically if we saw average machine hours dropping off, we know that utilization is dropping off and markets may be slowing down, and vice versa if we see hours going up. And it also provides our engineers with quite a lot of data as well, so that they are able to apply in improving product designs going forward as well.
I'm good on questions. I think we can hand back to Vanessa if you want to just wrap up for us, please.
Thanks, Mark. Thanks for Finance Ghost. And thank you to everyone who participated today. And a real special thank you to Ashley and Karen. Thank you for the time that you've given up to explain the strategy, which I think is very exciting. We hope that everyone who's been on this call has enjoyed it. And if you want to listen to it again, it will be available on the Unlock the Stock channel around Monday. So go and have a look at that. And if you want to join us, the next session we're hosting is on the 25th of April, and we'll be covering Astoria. That's another repeat company that's coming onto it. So thank you, everyone, and goodbye.